Welcome to this video on the limitations of the close-to-close estimator. All estimators have sampling or measurement errors. In physical science, errors are because the apparatus has limits. We don't know if what we measure to be 1 centimeter was actually only 9.9 millimeters. The situation here is different. An observed price is a price. The question is how representative is what we observe of the true process. A soccer player might score 4 goals in a match, but we don't expect that to be what he would average. We see on the screen that even when estimating volatility from a generated time series with constant, known volatility, we will get significant sampling error, just due to luck. And the sampling error scales roughly as the inverse of the square root of n. The spread of results for 30 days is shown on the screen. A decent rule of thumb is to use between 20 and 50 days of prices. If we were confident that the true, unobservable volatility wasn't changing, we would be confident in using more data, and thus having a smaller sampling error. It is natural to think that sampling data at a higher frequency would help with this. But this introduces different problems. First, high-frequency data needs to be cleaned and filtered to remove bid or ask bounce effects. Next, we are now measuring a fundamentally different thing. In real markets, what happens at different frequencies need not be related. Daily volatility and aggregated hourly volatility are not the same. Even daily and monthly volatility can be different. In the graph on screen, you can see the daily volatility in blue. Since the price is range-bound, the price at the start of the month and the end of the month is the same. This means that monthly volatility is 0, while daily volatility is high. Overnight jumps also need to be accounted for. We can see on the screen that the return from the close of today to open of the next day can't be treated the same as the return from 9:30 to 9:31. If we are, for whatever reason, only interested in what happens during the day, we can just set the overnight return term to 0, ignoring it. But for most uses, we need to separately estimate the overnight volatility using the close of one day to the open of the next, instead of consecutive closes. We can then combine this with our intraday estimate. Of course, now our overnight estimate has as big a sampling error as if we just used the daily close-to-close estimator. It isn't clear we have gained anything. Further, while mathematically correct, this combination assumes that overnight and intraday volatility are part of the same process. We see later that this isn't true. It is probably better to choose a time scale that suits your intended use. If you want to estimate volatility to trade options with maturities of days, weeks, or months, you should probably use daily data. If you are trading options only intraday, you should probably use intraday data, and just set the overnight return to 0, that is, ignore it.